good morning, everyone in Asia, and good night for people in North America, and for those of you in Europe. I think you're about to get to bed, or you're already sound asleep. Welcome to the Capital Market Development webinar by ABF Yao in collaboration with Tsinghua, with Tsinghua and CHK, Shenzhen and Hong Kong, and then US. Today's seminar's title is Foreign Investors Informed: Trading Experiences of Foreign Investors in China. Our presenter would be Christian LUNDBLAD, the Richard Levin Distinguished Professor of Finance and Senior Associate Dean for Faculty and Research in Kenan-Flagler School of Business, U of North Carolina at Chapel Hill. The co-authors are Donghui, Xiaoyan, ZHANG, and ZHANG. Thank you very much to the presenters and the authors. Now the floor is yours, Christian, please. 25 minutes.
Bernie, thanks everyone for having me. So you've heard this is joint work with several co-authors. They are largely here, so they can help answer some of the tough questions when we get there. So I've got 25 minutes. I want to talk about foreign investors in China, and so sort of to motivate things to some degree. And certainly no surprise to this audience, but this is a huge market, increasingly accessible to foreign investors, but under-owned perhaps. So China is the #2 market by market capitalization, at least when you put all of the exchanges together, but it still is short of its GDP weight. So it's sort of too big to ignore, but somewhat overlooked and under-researched, I would say. Where is the market? It's quite fragmented, right? So it's obviously onshore in the Shanghai and Shenzhen exchanges with A shares predominantly. It's in Hong Kong with kind of cross-listed or other, sort of constructed instruments, to some degree overseas in the US with cross-listings and the like. But there are some idiosyncrasies that remain and are particularly, unique to China, I would say, in the sense that despite the progress that's happened in the Chinese capital markets, the A-share markets still remain retail dominated. There's been some institutionalization. We'll talk a little bit more about that later. And that does, sit quite differently from the ownership patterns that we might see in Hong Kong, even for, kind of cross-listed securities. But when we think about, foreigners in particular, there has been significant liberalization efforts, right? So all kinds of different programs and different access points. And so as the foreign investors have increasingly played a role, the question to some degree is, are they informed or do they look, very different from kind of local institutional investors? And I would say this has become only more prominent, in recent years as, key index players have been adding China to the index weights, and that just has no choice but to, put, Chinese equity investments and increasingly even fixed income investments, although that's not what we're going to talk about, on the radar screen of foreign institutional investors of all types, right? So it's a central question, I would say, for us, but it is also one that is rooted in some long-standing, issues. So foreign capital can play a really significant and positive role in equity markets, in the cost of capital, investment and growth inducement, corporate governance, information transmissions, price efficiency, and the like. And so as China has over the last, several decades consistently invited foreign investors in a very slow and deliberate fashion, nevertheless, opened up to a significant degree, this raises the question of whether we see something interesting going on here with respect to price discovery and information, informed trading and the like. And so just to put this in perspective, foreign investors' holdings of all types have grown, but they still remain modest. The institutional share is, somewhere in the ballpark of, 15 to 20%. And so this is in that range, but of course, just reminding that this is a retail dominated market. So this is important, but remains kind of an interesting question. What do we have? We've got all kinds of different access points. So we can also get into the granularity that affords, right? So it can be, QFII investors, which disproportionately are institutional investors with certain restrictions on what it is they can hold and what kinds of lockups and constraints that they face, a parallel or complementary effort in RQFI, also some institutional investors, but of a different type. And then, of course, more recently, and in a very exploding fashion, we have, Hong Kong Connect, which has kind of permeated, I would say, the local market. Still largely institutional, although retail investors can access it, and the investment scope is somewhat different, right? So the available securities are also somewhat different. Nevertheless, this is all part of the, the contours of Chinese liberalization. And so, here's some examples, right? So on the QFI side, we've got, very well-known foreign institutional players that are coming in. So you might ask some questions about their degree of capacity to, obtain relevant information and make the right investments in it. The RQFI is a little bit different. These tend to be subsidiaries of overseas players, of mainland institutions. There's kind of an offshore currency component there that kind of plays a role in the background. And then, of course, Hong Kong Connect, which has been quite interesting. Again, not primarily retail, although that is part of the story to a modest degree. And so here we have, players like, the A-share fund that's offered by JP Morgan. Some capital restrictions, in terms of lockup periods and repatriation components. And again, some differences in terms of what is and isn't accessible, right? So we can look a little bit into that degree of granularity as well. So our research question is actually a very long-standing one in the literature, which is, are foreign investors informed, right? And in this particular case, we're going to be looking at the Chinese market, and what we're allowed to do that others perhaps can't because of the detail that our data afford is we can dig in a little bit deeper and kind of surmount some of the limitations that this literature has faced in some of its earlier iterations. And so we obtained some very interesting proprietary data from one of the main exchanges on the mainland side. And so we can ask, do foreign investors in their trading activity predict local stock returns? And so that's very deeply embedded in again, these kinds of long-standing questions. But then what we can also do is dig a little bit deeper. And so kind of what information are they perhaps able to process, or that they have access to, or can invest in unearthing, right? And so we can actually look at, firm level versus market level, or information that's sort of more local or global in nature. And then also, because these liberalization policies have a kind of, gradual nature, we can also sort of explore a little bit the degree to which those liberalization efforts have maybe affected these patterns along the way. So this is rooted in a long-standing literature. I'll move through this very quickly, but kind of whether foreign investors face informational disadvantages because of perhaps geographic proximity or language barriers. There's a lot of mixed results there. So we are not the first to contribute here. There's also a literature on how foreign investors sort of generally behave in Chinese, equity markets. And then, of course, there is a long-standing literature just simply on, institutional investors' informational advantages. And because the foreigners that we're looking at disproportionately are institutional investors, this kind of sits comfortably in that space as well. So again, relying on this detailed proprietary data, we're going to be able to kind of dig in more deeply and look at this kind of comprehensive evidence on the trading behavior. And we're going to look at kind of an in-depth analysis of whether and how foreign investors' order flows are related to different layers of perhaps public information, firm or market, local or global. And some early studies aren't really able to go that extra mile and sort of look a little bit more deeply at the nature of the informational advantages they may or may not possess. And we can provide, as I said, some evidence on the nature of the regulatory changes that facilitate this foreign investor access, that slowly liberalize over time, and whether that has some, improvement on the predictive power of local equity returns for foreign investors or not, or erodes it. So here's our data. It's coming from the Shanghai Stock Exchange. It's covering, a 3-ish year window. It's all foreign investors trading and holding data of the A-share market from the main board. And we're also going to complement that with some information on local institutions. So local hedge funds, mutual funds, and the like, to try to use that as almost a sort of natural benchmark to see how these foreign investors and their return predictive capacity or not kind of compares with what you see over here on this perspective. And of course, we're going to complement that with other stock return data and other characteristics that are going to be important to help us refine what it is that we're doing. So, QFI, RQFI, Hong Kong Connect investors are holding a lot of stocks, right? Maybe the second from the bottom, the third from the bottom, it gives you a sense of how much they're contributing to trading volume, which is, non-trivial, but not, certainly not the driving force. They're smaller than, the activity that's happening on, say, the very last column, which is local institutions. And then the last line shows you, the fraction by market cap of their holding. And again, this is an average over time, so that is increasing, as I alluded to earlier. But again, the holdings are smaller than the holdings that you see in the last column on the local institutional side. Again, just reminding that sort of the residual here is the large retail component that we know in the context of this particular market. So we're going to be looking at order imbalances, as is common in the literature. So for each type of investor, the different access points, whether it's kind of QFI or Hong Kong Connect investors or even local institutions, we're going to look at the extent to which they are sort of on one side of the market or the other. And so the order imbalance is going to be at stock I for date D with respect to a particular class of investors that are holding or trading that particular security. And then we're going to do this across the different categories that we have. And so this is going to range from +1 to -1 as we imagine that. And we can kind of imagine the extent to which there's some variability in that, particularly in the cross section, because that's where a lot of our econometric strategy is going to come from. So if you look at the second column, the standard deviation, I mean, you can see there's a fair amount of variability in how that changes, for across stocks in terms of what it is that foreign investors, or in the bottom column, the bottom row rather, the local institutional investors are doing in terms of allocating or unwinding positions. And the last thing I think I would mention is the correlations here across these things aren't particularly high, so they are not the same plays. Let's kind of use that.
Christian, sorry to interrupt you. Would you mind to clarify a bit for people like me who do not know the details? Who are the critical players in each of these four groups?
Yeah, so the QFI investors are foreign, very well-known institutional investors, Goldman Sachs, for example. The RQFI tend to be subsidiaries of mainland investors. So there's a kind of offshore currency component there as well. The HKC are largely institutional investors, but they could be retail investors. And the local institutions are mainland Chinese mutual funds, hedge funds, and other institutional investors at home. So
is there any mainland participants in HKC?
There could be, if they use that as a backdoor navigation or something. So invariably, yes. But that's it. They are going to be targeted as foreign players because they're doing something for whatever reason, which could be strategic. It could just be a part of a trade that's happening in a multi-pronged sense, right?
Thank you for the clarification.
So I would put it that way. So let's ask the question that's very common in the literature, which is, are foreign investors from any of these different access points informed about stock prices in the Chinese market? And so our first hypothesis is, are their order flows able to predict future stock returns? And so we're going to do this in a cross-sectional Fama-Macbeth sense. So we're going to look at all the different stocks. The return then over the day is going to be essentially predicted by the order imbalance associated with the different categories of people delineated by capital G here. There'll be some other controls there that would be normally consequential in such a thing. And then we're going to run this cross-section by cross-section. We'll record then, as it's standard in the Fama-Macbeth kind of approach, the coefficient, and we're going to study that object's properties. So to the extent that variation across different players is showing something in their order imbalances, is showing something about future return predictability, that's going to show up in a positive coefficient, and then we'll sort of see that show up time period after time period in some way that's statistically significant when you kind of clean up the econometrics to some degree. So here are those, the time series average of those cross-sectional A1 coefficients. And so if you look across QFI, or say Hong Kong Connect, or even the local institutions, to kind of give you a sense of a benchmark, that order imbalance for day D-1 is indeed significantly associated with returns that are happening in day D. And so you can kind of map that into what does this mean for kind of the interquartile return difference that comes from that coefficient, which is maybe a little bit hard to interpret. And so that's the third row over here. And so that's a daily return of, say, 12 basis points, 10 basis points, something in that range. And so you can magnify that up, and we're talking about something that's consequential. And the particular one that I think we're going to see sort of show up a number of times is QFI and Hong Kong Connect. Both have something to say over here, and they are in the ballpark or range of some things we're observing on the local institutional side. So that's kind of interesting, I would say, to at least note. We can also do that over time. So we can sort of allow this to manifest over several weeks. So is that kind of predictive power sort of transient? Does it look like some, liquidity kind of story, or some kind of, absorption of liquidity provision, or is there something that's more persistent? And so as you kind of take this out over multiple weeks, you see some action over here. And again, the kind of peach colored one is the local institution players. And you can see something kind of complementary that you observe in the QFI guys. Again, very well-known, high-powered foreign institutional investors. What is interesting is against whom are they trading, right? So there's some work by my co-author with other co-authors that actually shows that smaller retail investors on average actually negatively predict future stock returns in their behavior. We can observe the extent to which these different players are trading against others. And so the way I want you to read this is like BBS. So the first letter there is a buy or a sell by the foreign player. The second letter is a buy or a sell by the local institutions. And the third is a buy or a sell by the retail investors. And so if you look at the first two rows over here, you can see disproportionately more than half of the sample is associated with situations in which the foreign institutional investors largely and the local institutional investors are kind of on the same side. And they seem to be on the opposite side of the retail players. There's some mixed results elsewhere, but actually if we dig into this a little bit more, we can do our same kinds of cross-sectional regressions. And what I would ask you to sort of focus on is like, row by row, is that order imbalance and the coefficients that we observe, the statistically significant coefficients, is that associated with situations in which, somebody is kind of trading against the retail investor, or the foreign investors that we're interested in are largely trading in the same direction. And if you scrutinize this a little bit, you can see that the first two rows are pretty consequential, both in terms of statistical significance, but also if you go down to the return, interquartile returns that are kind of implied by this coefficient, you can see there's a lot of situations in which the foreign institutional investors seem to be trading against the local retail players. So that's kind of the directionality that our data affords that not every other study that has preceded us has been able to kind of dig in more deeply. What else do I want to say? Well, there is a kind of long-standing idea out there, and again, there is this mixed evidence that precedes us that maybe geographical distance or informational asymmetries kind of make it difficult for foreign investors to dig in. So, what are we going to do? Well, we're actually going to look a little bit more deeply and say, well, what kind of information are we talking about? I mean, is it foreign investors' order flows can predict firm level news? So we can look at particular moments when firm level news is particularly salient. And so we can, marry this with things like earnings announcements, or analyst revisions, or we can look at local media and sort of, use some of the technology that's out there in the literature to try to, put scores on different news items to get a sense of what's actually moving the market. And is it the case that foreign investors and their trading behavior is showing up as predictive, particularly in moments like this, or not? So we can actually dig in more deeply in a way that much in the literature has struggled. And so, here's one piece of advice, of evidence. So, can foreign investors and their order imbalances predict, future returns around, some of these firm level announcements, right? Or whether it's an earnings announcement or an analyst revision or something like that. And what you can see, particularly in, say, column 1, is sort of the cumulative abnormal returns that manifest going forward are, pretty sizable and statistically significant. Not at the same magnitude as you see on the far most right column, which is, again, the local institutionals as kind of a mental benchmark, but nevertheless something that I think is kind of telling, which is something that's going on there. And we can actually directly do the Fama-Macbeth regressions that we were doing in the cross section and augment it with moments of these kinds of announcements. But we can ask a question of like, hey, is it the case that this is happening on not just an earnings announcement, but an earnings announcement that is associated with a sizable return movement? So we're gonna couple this with what we call sort of big news, which is a situation in which the earnings announcement comes in at a moment when the stock return is also quite high, suggesting that arrival, fundamentally moved the market in a way. And so we can ask, is it the case that the foreign investors are sort of in the right place at the right time in their trading activity around those moments? Not just firm, announcements, but firm announcements that fundamentally move the market in a big way. And the answer is yes, actually. So the first column here is just sort of what's happening around these earnings announcements. But the second column, in a cumulative sense, the first column plus the second column, the second row rather, tells you, what's happening around those earnings announcements or other kinds of firm level information when the market is also moving sharply in the next day. And so here you can see a really sizable effect, which also shows up, if you look a little bit further down, in very large kind of implications for interquartile returns. So, around these kinds of firm level news, interestingly, foreign investors seem to have some kind of compelling informational advantage or information processing capacity or investments at precisely these moments that are pretty fundamental. You could do the same thing for, say, media. So you could look at media announcements, and that is coming from Chinese media sources disproportionately. You can put scores on those, and you can ask things like, when there's an announcement or some kind of media item that fundamentally moves the market. Again, this kind of big news. So it's a situation in which there's a media announcement, but the market significantly moves in day D. Is it the case that in day D-1, the foreign investors and their imbalances are, significantly predicting ultimately what's happening? And again, particularly for QFI over here, you see something that is that's notable. Again, last column, local institutions, again, pretty compelling over here too. So there's something that's that's worth noting as a kind of mental benchmark. But the QFI investors in particular here have some interesting things that are going on. So what else do I want to dig in sort of in the interest of time? So I guess two things that I would mention. Number one, what is it that these foreign investors are doing, right? So is it the case that they're making, significant investments in local language or local talent? And so we have some kind of anecdotal evidence which would suggest that's true. We also have, some evidence that suggests that firms that are more overseas in their nature, so they've got more sales and revenues associated with external activity. Actually, these degrees of predictability are somewhat bigger. And then two more things that I want to show before my time is up is we can also ask some questions about market level information, right? So to the extent that foreign investors may be better informed at kind of a market level, so can they process market level information? We can also do similar kinds of exercises where we could say run instead a time series regression, where on the left-hand side, we're going to look at the market return. And on the right-hand side, we can kind of take the aggregate order imbalance of, say, all investors of a particular type G, foreign investors in particular, we're going to be focusing on. And then we could also look around periods of kind of big news or smaller market reactions. And so let me show you that, and then
Question about 3 minutes.
Yeah, sure. And then I'll
thank you. Yeah.
So again, in a time series regression kind of context, what do you see? Well, it is the case that at a market return level, there is some interesting degree of predictability at that level in terms of aggregate order imbalances that you see sort of showing up. So if we look at sort of, row 1 or row 2, which is date 0, or maybe over the next several days, again, you can see kind of QFII investors, or to some degree Hong Kong Connect investors, collectively in their order imbalances are indeed sort of predicting what's happening at the overall market level going forward, in a way that sort of mirrors what you see also on the local institutional side. So again, this is the kind of thing that one can do by having the detail that is that's afforded by these data. So let me show you one more thing, and then I'll wrap up and pass the baton on. So the last thing I wanted to mention is we do have this interesting environment where the regulatory frictions, or the reform is gradual in its very nature. So the regulations are not sort of boom. I mean, it's really almost a gradual nature in which quotas are gradually relaxed, more foreign investors are allowed to come in, exit restrictions are alleviated to some degree. And so because we've run this cross-section by cross-section, we can actually study the extent to which the temporal patterns in that forecasting coefficient from the Fama-Macbeth regressions, whether that actually evolves over time. And this could go either way. I mean, one is allowing more foreign investors access could augment their predictive capacity to the extent that they can come in and make the appropriate investments in local talent and the like, or it could go in the other direction, right? I mean, I mentioned earlier that the MSCI A-share inclusion could bring more index investors from outside, passive investors who have no information interest even. That's not even their business, right? And so this could go either way. But what we're going to do over here, and this will be the last thing I'll show you and then I'll wrap up, is we can look at that coefficient that's kind of capturing the degree of each foreign investor's predictive capacity, and we can explore the extent to which that coefficient is changing as the regulatory environment is changing. And so this is my last one, and then I'll conclude. So this is what you can see is, in some cases, there's some evidence, and it's quite mixed to be clear, but at least for QFII or RQFII, in some cases, you can see that the relaxation actually seems to augment. That means this coefficient of prediction is getting somewhat bigger as foreign investors are allowed greater degrees of access points. And these different dates that we employ, you can kind of dig in on the paper to see what kind of what's what in terms of how that regulatory process has gone on. So let me conclude, and I'll pass the baton. So again, using very detailed proprietary data from the exchange, we find that QFII, RQFII, and Hong Kong Connect investors, particularly QFII and Hong Kong Connect investors, have some return predictive capacity over short and long horizons. And then here's, I think, what's quite interesting and maybe even surprising, I would say, which is these foreign investors are able to predict firm level information, right? Or at least the return implications of a firm level announcement. And so it's significantly stronger on some value relevant firm level news days associated with price movements. They can predict to some degree market level news as well. But I think it's the firm level news that's the most compelling. And then finally, the relaxed regulatory environment has, just to a modest degree, improved foreign investors' return predictive power over time. Thanks very much. I'll pass it on.
Thank you, Chris. Thank you very much, Christian. When I opened up the seminar, I did not describe the organizers well enough, so allow me to try one more round. This Capital Market Development China and Asia is organized by ABF-EL and BFI China together in collaboration with NUS, Wudao, CUHK Economics, and CUHK Shenzhen, and also SAIF. I want to thank all the organizers and collaborators. And now I want to thank the Dragon Tang from Hong Kong U, Professor of Finance, to serve as the discussions dragon. 20 to 25 minutes, yours. Please take us forward. Again, thank you, Christian. Wonderful presentation.
Thank you for having me. So I learned a lot from the paper, and also the paper made me think a lot. So let me first just summarize what Chris just presented. So the research question of the paper is very straightforward. Foreign investors informed, particularly in China in this case. And they have this very unique, highly valuable data, account level, daily trading and holding data from this 3.5 years since January 2016 to June 2019, and is from Shanghai Stock Exchange. I think this really is nice for the stock exchange to make this data available for research. And what they find is quite striking that foreign investor, their order flow can predict stock returns on daily basis, and is not temporary, is not reversed. It actually can last for 12 weeks, the predictability. And the final result, there are many results. The final result Chris just presented is China is actually having a regular pace of market reform and the liberalization of the stock market. And this actually make the effects stronger, right? So that's really new evidence to me. So the first contribution the paper have is really presenting this unconventional new results from China, because what we have from prior studies based on other countries, actually foreign investors cannot really make a lot of money in those, especially emerging markets, right? Or Asian markets. I think most of the research is based on, and I think this is useful for us to know, because now it's a kind of a different environment, right? Different setting, and China is a bigger economy than probably some other emerging markets. So it's useful to know. More importantly, I really appreciate the paper as a reference, right? If anyone wants to learn about the foreign institutional trading and all the reforms in China, then this will be very useful for anyone to read or to cite. So this is really a valuable research output. And I like to also want to emphasize that this finding made me thinking, because right now I'm trying to be a foreign investor to Vietnam, right? I'm trying to invest in Vietnam, and it doesn't look easy. I don't think it's going to be easy to make money in Vietnam as a Hong Kong-based investor. And also, right, there are new situations, different regulations. So I encourage everyone to read this paper, especially in the future, right? If you look at the new markets like Vietnam, then this will be useful before we really try our hands. So here comes to my comments. Actually, my first comment is just as Bernie pointed out, right? Bernie asked during the presentation, who are those smart foreign investors? They make money, they predict returns, right? Their order flow can predict returns, and actually can be quite effective, right? Next day, and also all the way to 12 weeks. So I thought that this list should be, at least a part of the list should be available. So I went to the CSRC. That's the Chinese version of SEC in the US, right? The China Securities Regulatory Commission. They actually make the list available on their website. And the names are, right? And also Chris made very clear about all this identity and all this institutional background, institutional knowledge. And you can see that the first QFII ever approved, right, back in 2003. The scheme started in 2022, but really get launched in 2023 was UBS and then Nomura, right? So that was the first two approved, and also the third one, Morgan Stanley. So that's consistent with our impression, right? And you can look at the whole list from CSRC website, and there are also historical changes of the list. So if you look at the December 2019, that will be different, right, from October 2019. But then these are only the beginning, right? There's three of the QFIs. If you really go down, then you see some other names. Chris also mentioned, but this is QFI, is not the RQFI. So RQFI is a relatively minor player. RQFI is using renminbi to invest, right? Here is people use US dollar to invest and then convert a dollar into renminbi to invest. And here I saw some names I would like to point out because I'm quite familiar with them. First, Zhongtai, right? Zhongtai International. Because one of the top executives of Zhongtai was my neighbor for a long time. We go to family holidays and our kids play for many years. So I know this is just part of, is a subsidiary of Zhongtai in Shandong province, right? Zhongtai is Zhongguo Taishan, right? The Tai mountain. So they came from mainland. And also I would like to point out they have this the head guy for trading is a PhD in finance from Wharton, and he was actually a former professor at the SMU in Singapore. So he was in charge of the trading. So you see that, of course, he knows China, he knows US, right? He got a PhD from Wharton. So this is this is state owned, right? China, the Donghui is state owned. And another one, of course, the next one, number 307, right? Actually, for this October list, there are 313. So 307 is also another mutual fund, one of the earliest mutual fund in China. They came to Hong Kong. The third one on this list is a Snow Lake Capital. That's a hedge fund. I would like to mention a little bit more because this hedge fund is not trivial in my view. I don't know how big it plays. It got licensed right in December 2018 towards the end of the sample period. And the Snow Lake was started by this guy, right? This guy Ma Zhiming, right? And if you read Chinese, you can see that he's like famous investor. And he has an English name, Xiaoyan Ma, right? Xiaoyan Ma, and he worked at the U.S. hedge fund, the Zijian Brothers, and also before Credit Suisse, First Boston, before he started the Snow Lake in 2009. Why is it called Snow Lake? That's because when he was born in Hangzhou that winter, there was a big snow on West Lake. So Snow Lake is named after his birthplace, right? Also at the time in 2009. And actually, when he started the hedge fund, he was 20-something, right? He graduated from UC Berkeley with dual degrees in applied math and economics. And after like 4 or 5 years working experience, he started his own hedge fund, $1 billion hedge fund. So I think he definitely was unusual. Like in the 1990s, he could go to US for undergrad. By my judgment is quite unusual background. And he was actually seeded by Hill House, right? Hill House, if you know, is the largest investor in China, based in Hong Kong. The founder is ZHANG, right, from Yale. So he was seeded by Hill House, and he had a lot of connection, including to the real business side, right? I think there's a Sunak, a real estate development company developer. The Sunak's founder's son was his analyst before, right? He was well connected, and most striking to me is he was actually a Hong Kong Stock Exchange listing committee member. That's super powerful, right? If you are on the listing committee, then for quite many years, right? Hong Kong was the #1 IPO market in the world, and being a listing committee member, and especially at his young age, right? I think he was the youngest one on the committee. So his background definitely was unusual, and that's his Snow Lake. And another thing noticeable for Snow Lake is Snow Lake was actually the hedge fund behind the collapse of or the scandal of Luckin Coffee. So they hired 1,300 part-time analysts or people to dig out all this receipt and find the information that this Luckin Coffee was really cheating, right, for the accounting numbers. So just one case of Snow Lake, right? This is one of the QFIs. And of course, for the Hong Kong Connect, I'm probably one of the sample subject, but in Hong Kong, it's quite complicated because people don't have to put their real name, right? I think today or this year, Hong Kong will have like real names, then for the identification will be easier. But in my view, the most important player here is QFII. And the reason this made me thinking is this graph that Chris also showed, that the top two lines, right, the peach and the blue lines, they look so close, right? They go up and then they make a turn together. They look almost like identical to me. So the peach is peach color line is local institutions, and the blue one is the QFI, right? The qualified foreign institutional investors. So they are really close, and if you really make it bigger, then, or if you don't look closely, then they would actually be the same. So that also made me to really think who they are. Of course, there are 300. Now it's longer. The list is longer, they could be, right, the institutional arms of these domestic institutions based in Hong Kong, but they can also be truly foreign funds, and they can hire China experts, right? I think in the paper, Chris and his co-authors discuss like on page 31, like who they are, and especially like 25% of these QFIs located in Hong Kong. Of course, I don't know exactly which time point this is, but they cite the data from the authority, right? This from SAFE, the central bank organization. So this is one thing really want to dig out more into this who the QFIs are, right? They could be just very highly correlated. I think one thing they can do is really look at the correlated trades, right? I didn't put in my comments, but if you look at how highly correlated their trades are, then probably there's a network or there's a connection between the foreign investors and the local institutions. Another thing noticeable in my from this figure is the green line, right? The green line is the Hong Kong Connect, and they are not so informed, right? They are not so informative, especially over the long run. Their predictability does not go up, right? Unlike the other three groups, right? So that's another interesting observation that even though the Hong Kong Connect counts the most volume, especially in the recent period, they are not so, they are probably least informed. So that's something. Of course, we know that if you read China news, there are a lot of or quite a few investigations and scandals on the Hong Kong Connect and how they use cross border to have a like joint scheme. But anyway, that's not the main point. So besides who they are, right, then my next question or really want to know is how, right? How does these guys do it? What's their tricks and or information, right? How they are able to predict stock returns? And one answer could be that is just because they base their trade on public information, but they are able to use the public information or interpret the information better. Because a lot of information in China, in my view, may not have straightforward predictions, right? We have to think in different directions to know exactly the implication for stock market. So it can be just a better use of public information, but can also be private information, but it's not really that kind of inside information, right? It's like I work harder, I collect information, and those information are not really from insiders, just like the Luckin Coffee case that they dig out the information. Or it can be just inside information, right? That so Chris and his co-authors actually talk a lot about this, like firm-specific or market-level information. I guess they hesitate to really use those terms, like inside information. I'm not worried about this being like inside trading, but maybe the first two, right? Public information, but better use, or really hardworking, collected the private information that will be useful for us to understand how the foreign investors are able to predict return and make money. Because from the US, right, we have this RFS paper from Griffin, Xu, and Tobaluglu based on the NASDAQ bubble, right, from 97 to 2000. What they find is basically institutions, they don't really make money from those insider information from connected parties to really make money. Actually, it's more like they are better at processing information. So it will be useful for us to know this. And again, I think the key lies in the QFIs, because they have the strongest predictability, even though they don't have the most volume. And also because the list of the QFIs is known, right? We can know who they are. And another thing is I'd like to know a little bit more, or actually this sample period is quite unusual. So it's from 2016 to 2019. So this period I color. And you can see that this period, right, you can see this like inverted V shape. More interesting is actually before, right? Is that the 2015 that some of you know that China had this huge like run up and then crash, right? Stock market crash in 2015. And this crash actually had, I think, in my view, is one of the major episodes, right, in Chinese stock market history. In July 2015, the national team stepped in, tried to rescue the market when the market tanked, right? But actually it did not stop the crash. It continued to go down. And then they were found inside trading by this top executive. I think he was number 4 in the CSRC, and he was arrested. He was caught actually sending messages, right, according to some reports. And then one of the people connected to him, the CEO of Guosen Securities, actually committed suicide in Shenzhen, probably upon the pressure from investigation. And then shortly after, right, the CSRC chairman, Xiaoyan, was dismissed. So 2015 was quite unusual. I would say in 2016, people would be a little bit scared, even try to make money from stock market, right? They can be held accountable afterwards. So 2015 was quite unusual, can have a repercussion on the later years. And the people say the national team actually try to support the market, right? You can see that the market cannot go below 3,000 for the CSI 300 index. And also you see that from 2016 to 2017, the market actually went up, right? So 2017, you may also notice, was a critical year, is the 19th Congress for the Chinese Communist Party. So having this background is useful, but also another thing is 2015 is unusual because of the Chinese foreign exchange reform, right? In August 2015, we have this huge reform, and this reform officially made people realize that renminbi, right, will not just appreciate. So renminbi appreciated since 2005 all the way until like 2014, reached almost 6, right? The exchange rate 6 to 6.0, and then the central bank, right, made a change. So because we are talking about foreign investors, I guess the exchange rate may be relevant for them. More important here is that during the summer period, right, we had this Donald Trump launched a trade war, right, against China, and not only trade war, but also there were sanctions, bans, and also arrest. Right, the CFO of Huawei was arrested in December 2018, and also some U.S. investors could not invest in China, so they had to exit. So you can actually see some exits. So knowing this this background may be useful. That's why I have the following suggestions. I need to run faster. So my first suggestion is really separate the truly like foreign investors from other foreign investors based in Hong Kong, because they in Chinese they may be those fake foreigners, or in Chinese we call this 假洋鬼子, right? So they are not real ones. Then it will be useful. And the second is,
Question, 3 minutes. Would you be able to do it, please?
Okay, 3 minutes. So second one is the trading behavior of American institutions may be also worth investigation because of the trade war, and also during the summer period, right? There's a lot of interesting things if we are able to see them. And also, they also analyze the firm characteristics, but here I'd like to push a little bit further to say whether the analyst coverage make a difference. They have a lot of results based on like overseas revenue, SOE, etc. But maybe to show us which kind of companies the foreign investors make more money from. And also early sample versus later sample, as I mentioned, right? Especially the cutoff is February 2018, because that's the end of the run up, and later become more volatile. And also because during the run up, right? Because the result from table 12 shows that the buy orders are really the source of predictability. If the market is going up, then when you buy, you will predict return, right? So just to see which part of the sample generate more results, and also whether the latest sample, when US had a ban and when US institutions have to exit, then whether this will affect the results. And also, so Chris mentioned about firm level and also market level, right? So to me, if they can show some other macro like policy change, the foreign investor can predict like monetary policy, fiscal policy, or even foreign exchange policies, then that will be really striking, right? If they have any kind of evidence that those smart foreign institutions can know what kind of policy China will have. I have some other comments like writing. It's easy to read the paper, but I noticed like some places like page 5, second paragraph, seem to be misplaced. And also, if they can do an analysis on short selling, that would be also interesting, because I know the Chinese regulators, they really care about whether foreigners, right, create volatility through what short selling, and also whether their trading is procyclical, right? That will increase volatility, especially during like sensitive or important moments, because the local institutions probably they are more cooperative, right, during those important moments. And also whether, I think this question is really important practically for many institutions. I just talked to one Switzerland, right, institution earlier this week. So they want to ask whether can we make money in China versus putting our money elsewhere, right, especially in US dollar term. That's right, even though I can make some money in China, maybe I can also consider other markets, can be more interesting. And the last result from Chris' presentation, I find actually it's a little bit hard, or at least not so straightforward to understand. So the more reform, no opening, more liberalization, then the information informed trading by foreigners will be actually stronger, right? Then if I take to the extreme, so if there are like a lot more foreign investors, then they will, I think there will be some turning point, right? It cannot be monotonic. Okay, so that's my comment. And then whether, right, they can also use futures, and there are others like directly measure the informed trading like ping, see whether foreign investors for those stocks be foreign trading, the ping will be say higher or lower. And there are some other comments. And finally, if they can have some policy discussion related to, say, here the short selling and procyclicality, right, of the trading, that would be helpful for me. So sorry for running over a little bit time. I think this is really useful study. To me, I learned a lot about the institution background. And for anyone, right, this will be a good reference on Chinese financial stock market. And it's really important research topic. So regulators really want to know, because they want to continue to open up, right? As Chris mentioned, only 5% of Chinese A shares are owned by foreigners. And also this is very careful and thoughtful research design, very unique data, very unconventional results. There are many results, many careful analysis. So my suggestion will be really know, right, as Bernie just pointed out, the first question is who those foreign investors are, and also what are the sources of their predictability, and also, so this special time period, right, from 2016 right after the 2015 market crash, that will be also interesting to think about. And before the seminar, we also talk about whether the data can be extended to the COVID period. That also will be very interesting. Okay, so that's all. Thank you.
Thank you very much, Dragon. Christian, if you don't mind, let's open up the floor and source more questions before I give you time to respond. Okay, so let's see if anyone has any. Pushan, you go first, please. I see your hand.
Thank you very much, Christine, for. Sorry. Yeah. Can you hear me well?
Now I can hear you.
Oh, okay, great. Thanks a lot. When I noticed the predictive power of foreign investors are similar to local institutional investors. So I wonder, what's your benchmark? Are you comparing foreign to local institutional investor, or foreign to all the rest investors, right? So I think what would be surprising is that how foreign and the domestic institutional investor differ in their performance, rather than you compare foreign investors to like retail investors, because then we all know that institutional investors have a superior information advantage. Yeah, that's my thought.
Any other questions? Maybe yes, Zhiguo.
Yeah, one is really related to what Shen was saying. I didn't pay attention that at the firm level, that the big news things, do you see local people, local institution can also almost precisely predict the local firms' big event? Let's say, you know, earnings beats the whatever the forecasted by 20%, 30%, that kind of event. That sounds like if you're local and you can always beat that, that's really suspicious.
May I just raise one more question before I turn to you? Let me just make sure that I don't have anything from the Q&A. Okay, my questions are the following. Let me take the result as a given. And I want to ask a question, whether this is a reflection of the poor information content posted by the retail traders, the retail participants, so that the institutional investors actually particularly bring in a good role in bringing information to the market. The second question I have is I somehow cannot help but to worry about how this information thing contribute to really better guidance of resource allocation. Would you be able to say anything about that in your results? And also, I echoed the discussions, Dragon's point about we need to understand better about who the participants are, and we need to pay attention to the time regime change. Thank you for listening. Maybe I'll turn to Christian and also the co-authors, please.
Sure, I'll start a little. So again, thanks so much, Dragon, and thanks for the other. That was really helpful. I think the themes that we heard from everyone was a little bit like, who are these guys, right? So I think there's certainly more that we could do over there. Obviously, there is some heterogeneity, nevertheless, in who they are. Although, as I said, many are, sort of high-powered institutional investors, particularly on the QFI side. So there's a lot more to sort of dig in on there. So I'll take that. I guess what I would say is, their trades are not the same. The local institutions versus, say, the QFI and the Hong Kong Connect folks. So you can actually, look at the correlations. You can actually orthogonalize these and sort of explore the degree to which, one is kind of predicting. And there seem to be some independent things that are happening across the two. So that deserves further scrutiny, I think. But nevertheless, it's just a point of information. Dragon's point on public versus private information versus insiders, right? So I think that's an interesting one too. And so, what we're showing is that situations that would either be associated with an improved capacity to process public information truly, or to have some, relevant private information, the foreign investors seem to be interesting from that perspective, which is maybe not what you would have expected given the other barriers that are in place and the mixed results that exist throughout the literature already. I'm not really in a position to speak on insider trading, although to the extent to your last point, Dragon, if you think some of the scrutiny that was given to insiders post-2015 might disincentivize some of that activity, if anything, then that means that the activity we're seeing is migrating away from insider activity in an illegal sense to something that is a bit more just traditional information extraction and price discovery. So that's sort of interesting to say. And of course, the question that you also raised on overlays of foreign exchange and stuff, I think we'll just have to dig in a bit more. Other questions, benchmark, and I guess this was from several of you, Post-One and Jigua as well. The institutional investors, the local institutional investors, represent a small but rapidly growing part of the Chinese economy, Chinese markets, and they have some pretty impressive capacity in the ways that we're measuring it over here, right? So for us, it's kind of like, the foreigners, how do they look relative to those guys whom we think might have some informational advantage, particularly in a retail-dominated market? So I would say, on average, the local guys do pretty well. Local institution guys do pretty well, particularly around the announcements that are associated with big news. Now, gets back to the question of, are they doing something they ought not to? That's a deeper question. But the simple fact is the local institutions are interesting and a compelling benchmark. So we can infer what we want from that. The foreign investors are mirroring some of that behavior in terms of that capacity, and in sometimes not quite as pronounced. So I would say that's a good characterization of sort of the whole thing. And then the last point, and I'll let Xiaoyan say what she wants to say if you want to pitch in to Bernie's question. Could this be a reflection of the evolution of the Chinese market and the poor informational environment or the retail dominated nature? Possibly. I mean, it's still a retail dominated market despite the explosion of institutional investors. clearly the big banana question is the last thing you answered, which is like, is price discovery improving efficiency and then ultimately giving us better allocative efficiency in some way? Like, obviously that's the one that we care about, but I don't have much to say beyond the sort of normal bridge jumping that we do to say, if this is true price discovery, then hopefully it bears fruit in that sense. And if what precedes these kinds of players playing this role, maybe a market that has some retail distortions or something, then that's only getting in the way. But I can't prove that. That's in the space of hunches, right? So Xiaoyan, I don't know if you want to say something, but those are my answers to everybody.
Okay, I just want to add a couple of things. Everybody care about who are those foreign investors, and are they really local? Are they from China? I think from the official speech of CSRC leaders, they're saying a very small part is coming from China. So when we look at the correlations among the order flows from QFI, RQFI, and local institutions, you can see that in our tables, they're quite low. I think Chris mentioned that we also organize order imbalance of QFI with respect to local, and the other way around. They both have predictive power for the future. So in my opinion, I don't think QFIs are local institutions. Of course, I really appreciate Dragon digging in all those details, because it really helped us to understand the other question: how can foreign investors be so informed? We try to do that. We mentioned in the paper that, especially for QFI, they have they might look foreign, right? But they were originally from China. Now they work for Goldman Sachs, and then they know the local. They hire the best talents in the market, and they hire people who work in China. They can process the information very well. So I understand people feel like, how can foreign investors be informed about locals? Are they actually locals? They're not necessarily locals, but they do not have, with the development of the institutional investing over the past 10 years, they do not have to be disadvantaged. They have the access to the information. For the last question Bernie asked about, what is the welfare implications for the whole thing? And I think China right now is still welcoming foreign capital to come in and to improve its efficiency, right? It's particularly emphasizing that we want a high quality foreign capital to come in to further help to build a highly efficient capital market. Okay, that's what I have. Well, thank you guys. Thank you, Dragon, for reading our papers so carefully.
My pleasure.
May I ask an additional question? Dragon, it seems that you want to say something. Do you want to go first?
No, I just say thank you for acknowledging this comments.
Yeah. Well, there's something in my mind that maybe I should read the paper more carefully, and maybe the authors already and the discussions has covered the following. I could think of this as like the institutional investors, including those that are QFI too, information as marginal traders into equity price. That's a good thing. But they could participate in price manipulation. That would be a nasty thing. So is there any way that maybe you already have covered this? Is there any way to differentiate between the two? I mean, they both will lead to you observe the result, I think.
I think one way that's straightforward to do is if they're manipulating the price. Normally, we think they can manipulate price for short periods of time. If we do it for 3 months, and then you still see that there's no reversal, that maybe it's not a manipulation, right? So when we look at 12 weeks of prediction, we see that QFI, RQFI, Hong Kong Connect, local institutions, they are still predicting returns. I cannot tell you that there is no manipulation, but it seems like aggregate-wise, they contain information. But I also forgot to mention that QFI, RQFI, they're not allowed to do short selling, I think.
Okay, thank you very much. Do we have any other questions? I want to thank Christian and co-author Xiaoyan and I think Zijian and also for bringing the paper here. We really enjoy and learn a lot. And Dragon, thanks a lot for your very informative and insightful comments. And so I guess it's time for us to say thank you very much, and I look forward to seeing you next month. The paper next month will be leveling up your green mojo, the benefits of beneficent investment, and the presenter is Xiaoyan Yu from Shanghai Jiao Tong University. And the discussion would be Professor Laura Stark from US Texas Austin. So everyone, thank you very much. See you in January. Enjoy Christmas.
Merry Christmas.
Merry
Yeah.
Christmas.
Thank
Happy
you.
New Year.